Today we're talking about something that came out of the news a while back, right? But as we see it, it's the subject of 50-year mortgages. It is the fact that they're talking about portable mortgages, right? Like came out a while back, but there's something missing from these news stories. I think people are talking about a lot of like the effects on the economy and whatnot, but nobody's talking about it as far as a rental property investor. So we're going to give you some not your average insights today. Welcome everybody to the weekly edition of your Not Your Average Investor Show. I'm your host, Pablo Gonzalez. With me, as always, a man that I affectionately like to call GC because he's got the genius concepts, knows how to generate cash flow, is a great co-host, and because his name is Gregg Cohen. First place in the AFC North, Gregg Cohen. Say hello, Gregg.
That's right. Go Steelers. Great to be with you all.
I say that as a lowly Dolphins fan who gave you that seat. What did I text you? What did I text you yesterday before the game, though?
I think you said you should just go to sleep now so we can get up and run and just avoid the misery that is being a Dolphins fan. Something like that.
Yeah. I forgot about that part of the text. I said I'm cheering for you.
Oh, that's right. I do
because I hate being a Dolphins fan and I want you to be happy.
You told me not to share that.
That's so good. Not to share with Alex.
Oh, not to share with my wife.
She doesn't watch the show,
but we can share with everybody. Okay.
All right. That being said, as we have teased, today, big deal. We are announcing the pre-sale ticket launch for the Not Your Average Investor Summit happening on February 19th to 21st, 2026, here in sunny Jacksonville. There is officially a website that is ready for you, jwbrealestatecapital.com/summit. And what is the secret password, GC?
The secret code is Summit 26.
Summit 26, capital S?
It doesn't matter with capitalization. Just no spaces. Summit 26.
Yeah. So if you go to jwbrealestatecapital.com/summit, you're able to reserve your ticket. It's for JWB clients only, but obviously we roll it out to the community first. I assume that's why so many people are so excitedly to be here. Joanna just put the ticket code and everything that you need to know in the chat right now. Ticket costs are $199.
Same as it was last year.
Same as it always was.
But it's an extra day.
Which
is cool.
Same price, more value.
What do you know?
And here's the deal. I want y'all to know. Oh, Bella Grain says he slept with last year's Summit blankie every night.
That's amazing.
Yeah.
We do have some pretty awesome gifts that come along.
We've got some awesome gifts every year. It's usually a surprise. It's still a surprise for us.
We don't know yet.
We don't know what it's going to be. So we'll be surprised along with you. But let us know if you are buying tickets in the chat. We want to start doing like a roll call in the chat of who's buying tickets. I know a lot of you came just to do this today, apart from, of course, hearing from Mr. Genius Concepts himself. But we want to see you. It's on yeah, we did. We already told everybody.
Yeah, but let me go through a few finer points.
Why don't you?
All right, because I'm hearing some questions. First of all, this is for JWB clients only, just like we did last year. It was just such a great group last year. We're going to do the same thing. Mm-hmm. However, this year, if you would like to bring a friend, you can bring a friend who is not a JWB client. Oh. So it is only for JWB clients, but you can bring a friend who is not a JWB client. So that's a nice way to bring your friends and family and those who are curious about what you're investing in to the summit. So that'll be pretty cool. This is the pre-sale. So we have 100 seats. We have 100 seats for Summit. That's what we had last year. That is going to be in the JWB new downtown corporate headquarters. We're going to unveil it for everybody.
Inside.
It's going to be inside.
The new JWB corporate headquarters.
On the 12th floor.
On the 12th.
Which is super cool. I actually haven't seen how the 12th floor is going to be laid out yet, so we're all going to see it. We're going to be moving into that office space early February. So this is going to be brand spanking new and super, super exciting for everybody. Getting some questions about accommodations of where to stay. First of all, now you know the dates. You know you have tickets. If you go ahead and buy your tickets now, you should be booking your flights. You should be booking a flight coming in either the 18th and leaving the 22nd, or if you want to book it, play a little close for comfort, you can come in early on the 19th. But there are going to be activities midday on the 19th. So either come in on the 18th, leave on the 22nd, or Be there first thing on the 19th.
Leave on the 22nd.
Leave on the 22nd.
Or come way before and stay way after.
Or stay as long as you want. We'll have a party.
It's a beautiful place here, Jacksonville, Florida.
And accommodations. So if you go to that website, again, jwbrealestatecapital.com/summit, there's frequently asked questions. One of the questions is accommodations. Right now we have some hotels that we are recommending that are right around the downtown area. Those are on the site. If you would like to stay at a hotel, those are great options for you, and you can do that. We also are going to make available some of JWB's own short-term rental properties, our own properties. We made some of these available last year, and we're going to be making those available again for us. That'll be available in the coming weeks. So that's not on the website. If you would like to book your hotel now, go ahead, do that. If you'd like to wait to book one of JWB's short-term rental properties, we have some that are downtown. We'll likely have some in other parts as well. You can wait a couple of weeks and then book there. And we'll, of course, be making all those details known for you.
I'm just showing the website now as you're talking.
Yeah, I'm trying to think if there's anything else. So
views down here, right? You'll see where the event will be held.
There you go.
Where you see where you should stay. There's some links to hotels right here that are recommended. These are the hotels, of course. Later on, we can have the links there for the short-term rentals.
Yes.
That's right. What should I bring to the event? Please bring yourself a positive attitude, water and snacks, and comfortable clothes. But you don't need to worry about packing right now, right? You see,
you do not.
You just gotta get your. You just gotta get.
And we're gonna be keeping you updated. There's gonna be a lot of things that we'll be announcing in the coming weeks and months. But the biggest thing is to get your ticket. So go there, buy your tickets. Again, we sold out, I think, in like 2 or 3 weeks last year from the time that we announced tickets. So we know, and it's the same. There's more buzz this year than there was last year. We know it's going to sell out. So please, if you are interested, go ahead, book your tickets. We're doing this as a pre-sale with the special code, which is Summit26. We're doing this for you guys because we're coming to the community first. If you're not a part of the community, you don't know the code, and you can't just buy your tickets on the site right now without the code. So soon, that is going to be opened up for all of our clients, and we're going to start to actually do a little bit more marketing for this thing. So this really is about bringing our community here. You guys are what created the opportunity to have the summit, and we want as many of you who can make it to be here with us come February. It's going to be amazing.
Saran Jennings said Joe and her will be there. Jen Filson, Fairy Godmother, says officially bought her tickets. Let's go, Jen and Renee.
That's awesome.
Pumped to see you there.
That's awesome.
Plus, anybody else in here already bought their tickets?
Jay Krupp, he got his tickets.
Jay Krupp got his tickets. Jay, all right, Jay, we'll see you there, buddy.
Andrew Barnhill.
Summit tickets are here. Drew Barnhill's up in the house.
Love it.
Okay. Dean Curry, early bird, said a few years he stayed in the JWB shipping container short-term rental.
That's right.
It's part of the experience.
There we go.
Yeah, so those will get snagged up for sure. But more importantly, this thing is going to sell out. This is our inner circle. We want you there, right? Like, which is why we're bringing it to you and enabling this like pre-sale thing, right? So all you got to worry about is your flights right now. There will be hotels. There will be Airbnbs. We'll tell you plenty of stuff to pack later. But buy your tickets, buy your airline tickets, get your travel reserved, put it on your Google Calendar or Outlook or whatever you use. We want to hang out with you for those.
We want to hang out.
Right? Cool. Awesome. Linda Evans says she'll be there. All right, Linda, good to
Drew.
Yeah.
Go ahead.
Yeah. Good.
No, well, I was saying Drew was asking for the link, so I'll say the link one more time: jwbrealestatecapital.com/summit, and the code is Summit26.
Yeah, I will put this right here in the chat so that it is clickable. So now you can just click it straight from the chat. I saw somebody bought a ticket here. Oh, Leslie Wilson.
All right.
Leslie.
The Maven's going to be here.
Of course. The Maven has like the greatest kind of like lifestyle of anybody I know. She's available for travel and is usually doing really cool stuff. So pumped to see you, Leslie. Michelle John, we will be there. Just got ticks. Yeah.
Love it. Love it.
John, love it. 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 All right, GC. To the topic du jour.
That's the topic of the day.
That's the topic of the day.
Yep.
50-year summit.
We'll be doing the summit in 50 years.
50-year summit. It is a 3-day extravaganza for 50 years. Yeah, these 50-year mortgages, right? Kind of over the last couple of months, it's been floated out there, extending mortgage terms beyond this, rarity that we have in the United States. It's a 30-year mortgage to buy a property into 40, 50-year terms. The core goal here sounds like is reducing monthly payments for people so that they can, get into homes and be able to afford home ownership here. Not widespread, kind of being piloted, being floated out there. When you first heard about this news, what were your thoughts?
I was surprised. You know, the 30-year mortgage has been just a part of what I've understood to be a part of real estate ever since I've been alive. I didn't even think about the idea of extending mortgages beyond 30 years. I just never even thought that. So when I first read it, I was like, what? You can do that?
Yeah.
You know? And I didn't really understand, you know, how all that came to be. I actually did a little bit of research and this was something that was kind of cool for me. So I was going to share it with you guys.
Okay.
Of course, we haven't always had 30-year mortgages in the US. Back in the 1930s and pre-1930s, mortgages were typically 5 to 10 years long. And then in 1933, the FHA extended the term to 30 years. So we've had basically 30-year mortgages. No, actually, I guess that was 1948. So anyways, in the 30s and 40s, we extended our mortgages to be 30-year mortgages. And since then, that really, you know, unlocked home ownership for our country. So my first thought when I heard it was like, I didn't know you could do that. How long has this been around? You know, how long have 30-year mortgages been around?
Yeah.
And then I've started to think through the pros and cons from our country perspective, from average homeowner perspective, from the investor perspective. And I think there are certainly some things, some wins in some areas, and there are some losses in some areas.
That's cool that you brought it back to this idea of like 30-year mortgages haven't always been around. Because when I first heard this news, the first thing I think of is, man, this seems like an inflection point, right? Like this seems like a moment. We've had moments in time in real estate where what was happening yesterday is no longer true tomorrow, or something is true today that wasn't true yesterday, right? I think of when I was in college, you were probably in diapers. And post 9/11, they allowed lending standards to like go out the window. And I remember like one of my fraternity brothers be like, "Oh, my mom bought me a house in Orlando," right? Like, you know, people made a lot of money back then when that happened.
Right.
I know post financial crisis, right? Like institutional, like the credit contraction and what was going on, and the REOs and all these different opportunities that were happening in real estate to buy homes at like a really, really low price. And then I think of that period of like 2020, 2021 when interest rates dipped so low and the deal was the debt, right? Like I want, do you think this is like one of those moments? If we were to go into 50-year mortgages, is this comparable to like the invention of the 30-year mortgage and all these other things and these kind of inflection points when you think about it?
Well, first, there is so much that would have to happen before we got to having 50-year mortgages that, I just wanted to make sure that everybody knows this is not on the table right now. This is not happening right now. This is a thought. This is a thought that is apparently, I don't even know where it's going at this point. It made its rounds on Twitter or X or whatever, and everybody sort of had an opinion. So we are far from it. Now, the question, if it would get enacted, is it like an inflection point as momentous or impactful as some of those other moments? In my opinion, no.
Okay.
Not at all.
Okay.
No. Those what you just described there shifted hundreds of billions and trillions of dollars in certain directions, and sometimes in places where it shouldn't have gone.
Sure.
And
it happens with all these kinds of moments, right?
Yeah, I just don't see it, as a huge inflection point for the market, even if it would happen. And the reason that I'm saying that is because, there are concerns for homeowners. So I'm not even sure how widely it would be adopted.
Yeah.
There's a lot
Let's
of
say it's widely adopted, though.
Okay.
Let's say all of a sudden in the United States, 50-year mortgages are all of a sudden like, go.
Well, it doesn't change it doesn't change who can qualify for a mortgage that much.
Okay.
Right. You're talking about like a couple $100 a month, maybe on average, for like a drop in the mortgage payment for a Jacksonville home, and maybe, $500 a month for maybe the average home across the US, which does bring some people into the buyer's pool. But it's not like you take people who should be getting a mortgage, or you take people who shouldn't be getting a mortgage, and all of a sudden now everybody gets a mortgage. So it's like, yes, this will momentarily help affordability, but it's not like it changes the game and you have a ton more people who all of a sudden have mortgages. And then the other part of this is, if we think about it, like, it momentarily changes the game and makes it a little bit more affordable now. But what do you think will happen to home prices?
They're going to go up.
They're going to go back up, and then you're going to have affordability constraints again, even with 50-year mortgages. So it's not like it is a systemic thing that all of a sudden you have way more people who have these mortgages, and the impact of it is less and less over time. So no, I don't think it's a huge inflection point.
There's a narrative out there around like haves and have-nots and how this affects it.
Yeah.
What is that?
Well, so now let's kind of talk about it from the homeowner lens, and then we'll talk about it from the investor lens, because I think the investor lens plays a little bit more into maybe, is this good for our country type of conversation. That's where we get to the haves and the have-nots. From the homeowner lens, the reasons to do a 50-year mortgage is because home price affordability is a challenge. And, when you have a 30-year mortgage, same amount of debt over 30 years with the same interest rate, it has a certain monthly payment here. If you extend it over another 20 years and make it a 50-year mortgage, the monthly payment goes down. So inherently, this helps affordability. So do we all want better affordability? Yes, that would be a reason to do it. Yep. The challenges and the cons, what people are pointing out are the additional interest costs that you have over time, which as an investor, I think differently about that. But just, if you look at the closing documents and you see how much you're going to pay in interest over a 50-year mortgage versus a 30-year mortgage, you're astounded, because it's hundreds of thousands of dollars of interest that you're paying more. And it feeds into this narrative that it's all going to the banks and all this, and nobody likes that narrative. So there's some challenges there.
So the bank is making more money off of the homeowner.
Yeah, but
he's also unlocking capital for the homeowner, right?
But we know that when you are investing in something that goes up over time, like when inflation happens, do you want to be the borrower or do you want to be the bank?
Well, I think we're going to learn that you want to be the borrower.
You want to be the borrower. So yes, there is a world where yes, you are paying the bank more interest, but it's actually to the benefit of the owner of the asset, which is the borrower. So I'm probably kind of combining points here, but yes, a reason why people are saying a 50-year mortgage would be a negative thing for homeowners is simply because they are paying more interest.
Got it. Drew Barhill just got his ticket officially. All right.
Yes.
Let's go, Remy.
So that would be a negative.
Yeah.
But I think an even bigger negative, which maybe makes a little bit more sense to me, is the rate of the pay down. The rate of the principal pay down for a 50-year mortgage is substantially lower than the rate of the pay down for a 30-year mortgage.
Okay.
And what this does over time is, if you have a 30-year mortgage and you pay a certain amount each month and it goes more to the principal, then you inherently have more of an equity spread in the property, even if the value of the home doesn't go up. So it's a less risky thing for the bank and for the homeowner to pay more of the principal down. And you get that in a 30-year mortgage. If you extend it over 50 years, I've got some of the numbers here. It's quite a difference. Yeah. Your percentage of your mortgage that is paid down by like 10 years into the mortgage or 15 years is substantially less when it's a 50-year mortgage than a 30-year mortgage. And there's obviously different viewpoints on this, but ultimately this creates it's a more conservative approach for both the bank and the borrower, because they'll have a higher equity spread by a 30-year mortgage versus a 50-year mortgage, simply because of the principal pay down. And that makes sense, because you know what? There can be momentary changes in our economy and momentary changes in the housing market, and things can happen. And so if you have a bigger equity spread, I think that's the thing that makes the most sense to me as to why 30-year mortgages are there's a whole big thing that I'm going to talk about in a second. But out of these topics, this is the thing that makes the most sense as to why not to do a 30-year mortgage.
Why people are hesitant.
A 50-year mortgage, sorry.
Yeah. Why people are saying this isn't a good idea, right? Because I'm not going to be getting that equity, that wealth that I believe I create by being a homeowner over time. It's going to take longer to build that wealth for myself.
Yeah,
because I'm just kind of like paying more rent than actual deposits into my own wealth account.
Right. If you are looking at a very myopic, like how much principal pay down am I paying and how quickly do I do it, it's not as advantageous for a 50-year mortgage as it is a 30-year mortgage. Now, the counter is you can always take a 50-year mortgage and just pay more down each month. Yeah. You can have additional principal payments and just not be on the hook to have to do it. But, our country doesn't really operate that way. And, so I can certainly understand, just from an overall more conservative approach for both banks and borrowers, to force people to pay more down. It's probably a good thing. And that's one of the reasons why people are saying, I don't know about the 50-year mortgage.
Okay. Got it. Now let's talk about what people actually came here for.
Yeah.
Break this down as an investor, right? Like when you, as a rental property investor, looks at this 50-year mortgage, I remember you saying, when this news first broke, that you're like, I'm in on this if I'm an investor, right? Like this would be a moment to pounce. Explain to me how this benefits from a rental property investing standpoint?
If you gave me the option to take out debt on an asset that appreciates over time, that's relatively inexpensive and pays for itself every single month, you could put it out 50 years, 70 years, 100 years. The longer you put it out, for me as an investor, the more I'm going to win. Because we understand the power of inflation, okay? This is where inflation profiting comes into play. And so, when you have an asset that goes up over time, the value of the asset's not the only thing that goes up over time. When we talk about inflation is one of your friends for rental properties, what I mean is that, like, yeah, the cost of eggs and the cost of gas and the cost of the house goes up, but you know what else goes up? Your income goes up. So like your income for doing the same exact job with the same skill level goes up substantially each year. When people get like a over time, right? Yeah. When you get like a 3% cost of living increase, like that's another way of saying you're getting paid 3% more for doing the same thing with the same skill level. Compounding. Yeah. And so in that sense, it's just like your income going up that whatever rate of inflation each year. Well, that really adds up. But with debt, you have a fixed rate for the debt, which means the debt that I take out today, my monthly payment is the same today as it is 30 years from now, 40 years from now, 50 years from now, if it's a 50-year mortgage. And that debt that I need to pay each month is a smaller and smaller cost to me the longer that it goes out. And that's important because I want to own as many assets as I can and get all of the good things that come along with owning that asset, like home price appreciation and tax savings and all that good stuff. But I want to pay as little of my income each month to doing it. And by simply taking out a 50-year mortgage, I'm paying that off in less valuable dollars. The paycheck that we all take home in 50 years from now is going to be way more than it is right now. But that mortgage payment that I took out 50 years ago is still going to be the same exact amount. So in theory there, if you gave me the opportunity and just my investor hat, I would take out 50-year mortgages all day, every day, because I understand the value of inflation profiting.
Got it. You've got some graphics here to show this, right? So we can show this. Like conceptually, I understand it as if you can control your inputs in an environment where the output continues to grow, right? Then you do well over time, essentially, right? Like in rental property investing, the input is mostly your mortgage expense, right? That's like the one really predictable over time that you can completely lock in. You have it at one price. As the economy continues to do its thing. We live in the United States. We know that we're going to be inflating at a certain rate. We know that the common practice in companies is to give 3% cost of living raises over time when, even when you're not getting like a raise or like a promotion or whatever, that's going to continue to compound. So people's incomes will continue to go up. And if you're looking at this thing where, like right now, let's say it's like 30% of my income is my mortgage, but my income continues to go up this way and it just stays here, it starts to become less and less. As an investor, you're doing that plus the cash flow that comes out on top of it.
Yes.
That also continues to go up as the value of the asset continues to go up as well.
Yes.
Okay, cool. Let's look at how you wanted to depict this yourself. Before we do this, just know this is for informational purposes only. This is not investing advice. We're not registered financial advisors, even though we're using real money. These are examples for you to inform yourself and go out and make the best decisions possible. Anything you'd add to that, GC?
Nope. Did a great job.
I'm getting better at that. All right. Talk me through this thing.
Yeah. So this topic gave us the first opportunity to really do a deep dive in what does inflation profiting mean? And so I thought this was the best way that I could show this. So imagine you took out a 50-year fixed rate mortgage today and you held it for 10 years. What would this look like in terms of the percentage of income that you spend on your mortgage payment? So today you can see here, and I did this for across the U.S. So the average market value of a home in the U.S. is $414,000. Let's say you put 20% down. That means your loan balance is about $331,000. Let's say the interest rate for your 50-year mortgage is a little bit higher than what you need to get today, just because there's more of a higher premium that you would probably have to pay on a 50-year mortgage. So let's say it's 6.75%. That means that your principal and interest, your mortgage payment per month right now is about $1,932. Well, the median annual household income in the US today is $87,100. So your percentage of your income spent on your mortgage payment today is 27%. But let's fast forward 10 years, okay? And I kept the market value of the home here because this is where everybody starts to get astounded, right? Yeah. Is my home really going to be worth $649,919 in 10 years for the average home across the US? The answer is, yeah.
It's likely what we're going to see.
It's likely going to be right around there because that's what happened over the previous 10 years and on average over the previous 40 years if you took 10-year increments. And this is the big value of buying and holding these assets. So the value of the home goes up so much. But take a look at what your percentage of income that you're spending to control this asset does, simply because of inflation, right? Our mortgage payment per month stayed the same. It's still $1,932 a month. But because of inflation, I looked up the average inflation rate for the US since 1914. That comes out to 3.3% per year. Well, 10 years from now, going up 3.3% per year and compounding annually means that the person who makes, or the household that makes $87,000 this year for the same rate, the same skill level, the same experience is going to be making a little over $120,000 that year. Yeah. And so that means your median household income per month, of course, goes up, and your percentage of income spent on your mortgage payments goes down. And ultimately, that's what we mean by paying this back in less valuable dollars. It's the pain associated with making the mortgage payment is a lot less because, you know, your income has also been inflated along with inflation in every other part of the economy.
Super interesting, man. I feel like in all these things, I do that math in my head of like, oh, what's a house going to be worth in 10 years or whatever, but nobody ever does what is the median household income going to do over 10, 20 years, right? Like, this idea of like locking in as a homeowner, locking in your rent, knowing that, median incomes go up and all this stuff makes a ton of sense. As an investor, it makes even more sense when you start looking at this thing and thinking, there's going to be more and more folks that are going to be able to like afford this thing really, really easily.
Yes. Well, let me pause you there.
Yeah.
It's not to say that things are going to be more affordable at that point, because it's going to cost $649,000 for a home. Rents are going to be a lot more than what they are today. Incomes are going to be a lot more than what they are today. So for the person in 10 years, I'm not saying it's going to be more affordable. I'm saying it's going to be way more affordable for you because
to hold it.
Yes, because you made a great decision 10 years ago. Yeah.
And for me to rent it out to someone.
Yes. Yeah. And that's a key point. That's why I love buying and holding. Like, you simply buy and you hold, and it gets better with time. This is one of the most impactful ways to show that it gets better and better with time.
Got it. So this is in 10 years. That happens in the 30-year mortgage, right? Like this is standard right now.
Standard.
Then there's 30 years. The numbers look amazing at 30 years. You want to just kind of like high level go through a year?
Yeah. Look at the market value of the home in 30 years. Yeah. I mean, I'm sure we should cue like everybody going like, huh, is that right?
Yeah.
I mean, if you use a home price appreciation calculator and you put it out for today's rate or today's value of $414,000 across the US, and say the average appreciation rate is 4.6% per year, compounding annually, you're going to see that home is worth about $1.6 million.
Yeah. And median household income in 30 years is going to be $236,000, which is nuts.
Crazy. But you know what? 30 years ago, people were saying, there's no way I could imagine the average U.S. household would be bringing in $87,000. Yeah. It just wouldn't have made sense 30 years ago.
Yeah, true.
Right? But this is why the point that you made there about how people sort of disassociate prices going up with their income going up is the source of this. If we thought about our income as just another price or cost, which it is, then we understand how prices can go up long-term because our incomes go up long-term. And it doesn't mean it's more or less affordable,
totally. Yeah.
So, but
the kicker.
Yeah.
You're right. Say it. Yeah.
Go for it. I'd love to hear it in your own words.
I mean, the kicker, I just didn't want it to get lost, right? I saw that you were going to go into it, but like, the kicker is not just, hey, look how much the house is worth. It's not just, hey, look at how median annual income in the US in 30 years is going to be 236,000. It's the idea that if you buy something today that costs you 26% of your income in 30 years, it's only going to be 9.8% of your income. It's almost like a third less. It's almost a third
Yes.
of the percentage of your revenue is going towards your household costs, your owning the home.
Yes.
Yeah, that's
Yeah.
fascinating.
So like paying debt down in less valuable dollars is so powerful.
Yeah.
It's like it's a third as hard to make your mortgage payment
Yeah.
in 30 years
Yeah.
as it is today.
Yeah.
But what goes up around you? Rents, home prices,
Replacement cost.
replacement cost, right?
Yeah.
Yeah. Which is a reason why home prices continue to go up.
100%.
You know,
100%.
your tax savings is still growing. So this is and this is hard to show on a pro forma, right? Like this inflation profiting is a little known, little understood, but like incredibly powerful wealth building tool. And then when you take it out to 50 years, it starts getting bonkers.
Let's take it out to 50 years and let's get bonkers.
There you go.
So in 50 years,
Yeah.
that home that was worth $414,000 is worth almost $4 million. Everything else stays constant, except median annual household income is now close to $500,000, 441,605. And now the percentage of your mortgage payment versus your salary is 5.3%.
Yeah.
So 1/5 of the original piece of the pie.
This is in essence why I would take out debt as long as I possibly could if it is in an asset that goes up in value over time, which is what real estate does, and it is relatively inexpensive. 6.75% interest rate is relatively inexpensive, and if it pays for itself every single month. I just want to accumulate as many of those as I possibly can, and I would love to extend the debt term as long as I possibly could. And if I did that, I would create more generational wealth for myself, my family, our community, right? This would be an incredible wealth building tool.
What makes this better, or does it make it better than the 30-year mortgage as an investor? Like if I'm still benefiting from these things in the 30-year mortgage, what is am I really thinking I'm owning it for 50 years? Like what's the why extend the loan term when it all really works so well at a 30-year mortgage?
I think that's a good question. Many people don't understand how good we have it as far as a wealth building tool in this country with it being a 30-year mortgage. That just doesn't happen in other countries. I think there's like one or two other countries out there that you can actually get a fixed rate 30-year mortgage. So in the US, we subsidize. Our country, in essence, subsidizes mortgages to make sure that we have this wealth building opportunity for those who know how to use it. So I think that's your point, right? We have the 30-year mortgage. It's already doing a ton for wealth building based on the example we just showed. Do we really need a 50-year mortgage?
Yeah.
If all the
just stop beyond, do we even need a 50-year mortgage?
Yeah.
Me as a rental property investor,
right.
If I have the option for a 30-year and a 50-year mortgage,
Right.
Why would I take the 50-year mortgage as opposed to just the 30-year if I'm already going to get all the benefits in 30 years?
Well, you get more benefits from the 50-year mortgage than you do than the 30. Yeah, because you get to control the asset with a fixed payment every single month.
Okay.
While it's going up in value and rents are increasing and home prices are increasing for an additional 20 years, and the amount that you have to pay each month still stays fixed, and it's much lower.
But is that better than in 30 years, the amount I have to pay going away? Right? Like if I have it for a 30-year mortgage, like in 30 years, I got no more mortgage payment.
Well, right. Yeah, you have no more mortgage payment.
Mm-hmm. So why would I want an extra 20 years of mortgage payment?
Well, you didn't pay as much of a mortgage payment for those previous 30 years.
Gotcha. I would be getting a discount on the front end of that piece. I'd be getting increased cash flow for the first 30 years.
Yeah. And, when at the core of it, if you have the opportunity to control an asset that's going up in value and you have much less of you want to control the asset for as long as possible while all the other good things are happening.
Yeah.
And so if you give yourself another 20 years of that asset growing and you paid less for the previous 30, then you're going to wind up with a whole lot more wealth being generated.
It's more leverage.
More leverage too, right? In essence, right? Like you would be able to qualify for more of a mortgage 50 years ago,
Got it.
which means if you have a constrained amount of capital, you might be able to buy 5 homes instead of 4 because you could qualify for more.
So the math on the front end would work out that I get more money sooner spread out over 50 years, or I get the same amount of money paying less for it over like monthly over the amount of time if we're going to go from 30 to 50 years.
Yeah, and I'm glad you asked because it really is about you being able to accumulate more assets with a given set of capital in the beginning and for you to pay less each month for those first 30 years is why it would. And then the kicker is that it's such a small percentage of your income for the last 20 too, that combination of all those things makes it advantageous from an investor perspective.
Cool. Yeah. Good breakdown, GC.
Yeah.
All right. We've got a couple of questions here. Il Maestro wants to know, how would depreciation affect a 50-year mortgage?
There's a lot that would need to be figured out here, which is why it is not happening right now. I would think that it is a long shot to happen. But so to answer your question there, El Maestro, I don't know. Right now, depreciation schedules are the standard is over 27 and a half years. I haven't thought about that. I don't think that really changes the IRS perspective, and I don't think it changes depreciation from a tax perspective, but maybe it does. This is one of a ton of really important things that would have to kind of fall in line for 50-year mortgages to even happen. Like there's government legislation that has to get approved for Fannie and Freddie, who basically back and securitize all of these mortgages. There would have to be a legislative intervention to even allow 50-year mortgages to be a part of what's called a qualified mortgage, which is what becomes a mortgage that Fannie and Freddie package up and then sell to investors. So there's a ton of questions, and we are so far from this actually becoming a reality. Yeah. And I don't know how depreciation would factor into it. I don't think it would change much, but I don't know.
Yeah, Drew Barnhill says depreciation is in the IRS code and wouldn't change unless the IRS changed the law. So that'd be a different thing that would have to happen as well. Right?
Yeah.
Eddie Harris from Hotlanta says, great points. However, you also need to factor in retirement age, which would decrease household income at that point as well.
Yeah. And that's another reason that people are saying, hey, this might not be a great thing. They're saying from a lifestyle perspective, you'll have people that have, if you take out a mortgage at age 40, you in essence might not be paying it off till age 50, till age 90 after 50 years. And people get scared about that. And so, yeah, I do think lifestyle is something that should be taken into account here. You know, the theory of what we're talking about as far as inflation profiting is this image helps, but it's not the whole way to go about this decision. I think there's a whole lot more than just return on investment that would go into whether or not a 50-year mortgage would be right for everybody.
Okay. That's not the only thing that people are talking about when it comes to changing what we can do with mortgages. Another thing that's being floated around there is this idea of a portable mortgage that allows a borrower to move their existing mortgage, the rate, the balance, the terms, from one home to the next home that they're buying instead of taking out a new home, a new loan. Idea comes around this, like allowing people to keep their mobility by allowing them to move homes and purchase other homes and stuff like that when they got to move. Not common today. Again, would need some regulation change and all these other things. So it's not happening, but it's being floated out there. GC, what was your thoughts when you heard that one?
If 50-year mortgages are really, really difficult to see happening, I just can't really see portable mortgages happening. There is so much structurally that would need to change for this to be possible that it just, when I heard it, I was like, the chances of that happening is just almost none, in my opinion. But I mean, let's look at why we're doing this. The reason why Bill Pulte and President Trump are sort of floating this is because they're trying to attack home price affordability, and and one way to attack home price affordability would be to increase supply. And one way to do that is to remove the lock-in effect. And the lock-in effect is everybody who has mortgages, like I have a 3% mortgage on my home, right? It's going to be really hard for me to leave my home because I have this mortgage in place. And there's a whole part of our country that is in that same place because mortgage rates were so low. You know, that is in essence keeping people in essence voluntarily locked into their home. And it's restricting some supply that could come onto the marketplace. And then, in essence, that would help decrease or help limit some of the affordability challenges that we have. It would also increase demand at the same time because now you would have more buyers that would be open to taking this 3% mortgage that I have and then going to that next dream home that they have or whatnot and bringing that 3% mortgage with them. So it's hard to understand what the effect of affordability would be because it would help both demand and supply.
Yeah.
But that's what they're doing here. They're trying to figure out how do we solve this big problem with just home price affordability, and they're looking at a couple of different levers that the math could work. It's everything else beyond it is really hard to see how it could play.
Yeah, that makes sense. I mean, it would increase supply because people are able to like leave this home that they're at and then move to another one. So I guess I see it as like it would shift supply. Like, wouldn't somebody have to be moving somewhere? I guess I'm thinking about it geographically. They could stay in the same geography, just upgrade house, but keep the terms of their mortgage in some way. Feels hard to figure out how you would buy like a bigger house and keep your terms and loan balance and all that stuff in your mortgage. I can't really wrap my head around how that math works in any way.
So you're saying it's hard to see how somebody could take a mortgage that they have right now, like a 3% mortgage, and then be incentivized to go to that next level up of a home and how the math could work?
Yeah. Like let's say I bought a $300,000 house and I've been in it for like 10 years and I've paid off, I don't know, 50K, on it. I have 250K left in the mortgage and I want to go buy a $500,000 house. Oh, obviously if I bought a $300,000 house and it was 10 years ago, I probably bought it for, so it's appreciated. Now I'm getting lost in the math, right? But
yeah, I got you.
But like, how would I take, let's say like my house is worth 450K at this point.
Okay.
And I want to go buy a $600,000 house.
Okay.
But I have a mortgage for 300 grand that I've paid off, like 50K on.
Okay.
And I need to go now buy a $600,000 house. Like, how does I don't know, man. Like, I have a hard time conceptualizing the movement of it.
So help me understand what is not making sense, because
well, I need to unlock
an
an extra 300K.
Okay, so it's like, where does that additional capital come from?
So like, how am I keeping my mortgage if I need to go get more money for
Gotcha.
it? Just extending the size of the mortgage?
I don't know.
Yeah,
I don't think they know.
Yeah.
Those are some really important questions. So now I understand completely what you're saying. In order for this to work in that instance, and for people to take advantage of it, there's going to be people don't have $200,000-$300,000 just to put down on the additional house, right? They would need to unlock some additional equity based on the new home purchase. And I think that's a part of it, But in essence, let's just say that that's the case.
Yeah.
They would allow you to qualify for up to 75% of the new home. So you only had to put 20% or 25% down or whatnot. You could combine what you already have as far as equity down payment, plus maybe they allow you to borrow at an increased rate, or maybe it's a second mortgage on it.
So maybe it would be like a second mortgage.
Yeah.
Keep that original one so it doesn't go up by all that much anymore. Okay.
I didn't look into it completely, so I'm kind of just spitballing what makes sense to me there. But yeah, to your point, you need to make it a way for people to take advantage of it without counting on them putting multiple hundreds of thousands of dollars to take it.
I remember when we first brought up this subject, you brought up the idea of Nimbyism and how that could be affected.
Yeah.
Explain to me that piece. So Nimbyism, not in my backyard, right? This idea that people don't want like things to change around them, right?
Yeah. Well, I just started to think, everything we're talking about here, 50-year mortgages, portable mortgages, we're doing this to try to solve the affordability problem, but there's pros and there's cons to it. And the cons are very significant. Like, for example, even though you heard me get really excited as an investor when it comes to 50-year mortgages, I'm not convinced that's a good thing for us as a country, because the haves and the have-nots will become a little bit more divergent. Debt is a tool that helps people who know how to use it acquire great wealth. But there's a very small section of our country that knows how to use it. And when you have a very small section of something that knows how to use something really powerful, it can create, more of haves and have-nots. And that's what's happened, especially over the last 5 years in our country. If you look at how low interest rates were, and you look at those who those who took advantage of opportunities and took out the debt at very low interest rates, they own a significantly higher number of assets now. and they have way more wealth because those assets have appreciated versus those who were left out, who didn't understand that the deal was the debt back in the day. And, as a country, having haves and have-nots, it's been proven over time that leads to many other challenges. So, the idea of the 50-year mortgage, while I think it would be a great wealth building tool for all of us who would know how to use it, I really have questions as to whether or not it's a good thing, for us as, citizens of our wonderful country, But saying all of that is like, what if there was a cooler, better solution where pretty much everybody wins? An overwhelmingly more number of people win. And that is solving the supply problem. If we just looked at the problem as we don't have enough supply and we increased and did whatever we could to increase the amount of housing that we had in our neighborhoods that we have, then ultimately what that does is it decreases the cost of construction and land development. If you can get more units on the same size of land, then the cost of the land becomes fractional for that developer. And then that development cost ultimately stays lower all the way through the time when it goes to the homeowner who wants to buy that home. And, this isn't a new concept, but like when you hear about real solutions to affordability, if they're not rooted in increasing supply, there's way more people that either win or lose. We can all win. I'm not going to say all. A vast majority of us can win.
People can win more.
More people can win more if we focus on solving the supply problem. Well, how do you do that? Government regulation, reducing red tape. But there's also this other challenge that we as people create for ourselves. And that's where Nimbyism comes in. Not in my backyardism. It's been documented that if you go back 30, 50 years and you look at our neighborhoods in our communities, we had a lot more of what we call missing middle housing. Duplexes, quads, apartments inside our middle class neighborhoods. Well, that largely has been done away with. We have a missing middle now. And a part of that is because we all say, I don't want that in my backyard. It's great. I love the idea of housing affordability, but not in my backyard. And then it's not just having quads in our apartment complexes. It's things like parking issues, parking regulations, and how anything that really lowers the density of housing units on a specific area. Certain things get approved at the local level that say, oh, you know what, instead of 50-foot wide housing lots, we need 75-foot wide housing lots or 100-foot wide housing lots. Well, ultimately, those movements increase the cost of housing for everybody. So, as I was thinking about all of this, I just feel like it's missing the mark a little bit. If we put our energies towards what can we do to reduce red tape, increase density of housing, that is the way that many more people can win when it comes to housing affordability.
It's more politically popular to give people access to more money than it is to give, access to more building inventory, like where it already exists, right? Like I lived this in Miami, right? Like the parking regulations, right? Like there's a small part of Miami that has that type of stock, that type of like zoning and housing stock. But they changed the parking regulations so no more of them can actually be built in a way that still, like makes it feasible, right? Like from like parking regulations to you're in a single family neighborhood, but there's plenty of land and you can allow people to maybe develop like an auxiliary, what is it, ADU? Like
ADU, yeah, that's a great example.
ADUs where they can just put like another kind of like housing unit on their lot and maybe have a place for their mother-in-law to start, but eventually it's two different houses or whatever, like those kinds of things. Folks like to fight that stuff because they worry about, well, who are you going to rent this thing out to? Like, are you going to now rent it to somebody that isn't like in my social circle or whatever? And yeah, man, I feel like that is, what I'm hearing from you is kind of like a call to, can we all not figure out a way to compromise better in a way to help more people win more, as opposed to just like easy buttons to like unleash capital that maybe over a long time doesn't actually like really help people and may actually exacerbate the problem?
Yeah, I think my call would be to understand the consequences of each of the decision. I think it's very easy to say, I want more lasting affordability for home prices in our country. And it's also easy to say, not in my backyard. And then it's easy to do other things that just might not have the lasting impact. But if we understand that the consequences of our actions, then I think that would be an opportunity for us to make more informed decisions. And I just don't think people equate housing affordability with Nimbyism. And I think that's one of the biggest challenges to home price affordability, is something that's largely what we create, as citizens.
Yep.
You know.
Yep. And man, I've even seen it at like events where people are saying like what JWB is doing. You guys are building units downtown. You're trying to densify downtown. And then there's folks that are like, well, don't build that because, you have to build it at a certain price. And then that's going to be like unaffordable for me. So like, don't add another unit because I still want like these old units to be built that aren't economically feasible anymore, right?
We do get a lot of pushback in certain areas for doing projects that would bring more density.
Yeah.
It's usually not so much about what is the cost of that unit going to be that's the pushback.
Yeah.
It's usually neighbors that say, hey, you know what? I don't want this brand new townhome community anywhere around my neighborhood. And, townhomes are a great way to get a higher density of units. Lower priced, affordable units. And so we tend to, if we do get pushback from the community, it might be because it's a townhome that's being, offered in an area that may not have townhomes or may have a very small preponderance of it, or you name it. People can have challenges for a number of different things, as we've seen. But anyways, just understanding that, like, we can't have our cake and eat it too, right? Like if we all want housing affordability to be solved, this is one which, in theory, if we all give a little, in theory, we could gain a lot,
Makes sense to me, man. All right. Q&A.
Let's do it.
Pedro Santorio says, so do you think 50-year portable assumable loan that lets sellers take their current low payment with them to their next house and allowing the buyer to assume it would help free up inventory and get the market moving? Like, let's say like the portable 50-year mortgage. Do you think that would actually move, like get inventory turning?
I don't know. I don't know that it would kind of get to a place of solving the problem that we're looking for, because it's going to free up demand and supply. Mm-hmm. Those people who are locked in at the interest rate of 3% or 4% now are going to say, hey, you know what? I'm freed up to go and buy that next house that I couldn't do because I can't get that 3 or 4% interest rate. But it frees up their house to become inventory, and it frees them up as a buyer to buy the next one. So I think it's region specific and probably neighborhood specific too. If you roll it out across the country, I think there'd be some markets that would really win here, because you'd have a lot of people migrating from the Northeast or California or whatnot to less expensive markets, Jacksonville being one of them. So I think we'd probably win on the demand side, but honestly, I just don't really know.
Okay. Mark Norman and I have had some good back and forths on LinkedIn about this thing. I know he cares a lot about kind of like affordability and the haves and have-nots thing. We tend to agree here, right?
Yeah.
So he's asking, if they did, imagine having the 50-year mortgage and only make it available for primary homeowners, excluding real estate investors. Do you think that would be a solution that would allow for more people to buy homes and not drive that kind of like haves and have-nots scenario?
I think at the core of it, it would be a wonderful thing for anybody who took out a 50-year mortgage if you are educated. And it's a very powerful tool if you're educated, because you would be creating so much wealth for that homeowner, that primary homeowner, over those years. But that's where the education comes into play, because people can get in trouble with it too. Because if they don't manage their lifestyle well, they're likely to have less equity build up in year 3 or 5 or 10 than they would have the other way. And that gives them less options if they lose their job or if things happen. So I just think, man, if everybody was educated like we are in this group, I would say it would be a wonderful thing. That's not reality though. So I don't know that it would be a great thing for everybody, even if you excluded real estate investors. It would really significantly increase wealth generation for people who took advantage of it. Whether or not people are educated and disciplined enough to take advantage of it is the real question.
Yeah, that makes sense. Not Your Average Guest says, what about a breakdown of systems reserves for maintenance, like a 30-year life of HVAC, plumbing, roofing, pavement, etc.? How would that change for a 50-year hold?
I don't think it would change much. because the breaking down of those elements to me doesn't seem related to the length of the mortgage.
True.
Right. So I think the assumptions that we would use would be the same, which is based on data and what the breakdown of those costs would be. So I don't think that would change.
Yeah, at the end of the year, at the end of the day, like an HVAC is what estimated at like 8 years, 10 years or something like
I was
that.
going to say, yeah, 10 years or so.
So it's like either way, that's shorter than the life of the house anyway. So
Yeah.
it was just like repeat the cycle more times.
Right.
Right. So
Yeah.
same kind of thing. Yeah, that makes sense. All Dude BJ McKay says for this 50-year home loan to work, higher income levels wouldn't qualify for the program and homes would be entry level. How else could it work?
BJ might know more about this than I do. Are those stipulations for the 50-year home loan program that they were talking about, that you couldn't qualify if you were over a certain income level and they'd have to be entry level?
Yeah.
Let's just assume that that's the case. And like I said, that, honestly, this is so far from actually being real that I think a million things would change between now and then. So a lot can change, but let's just say that that's the case. It still kind of comes down to the same place for me. It's a wonderful tool. I don't know that everybody can use it. And if you aren't educated and disciplined, this could be something like any tool that could harm, could harm people. How else could it work? I'm not really sure what he's asking there. What do you think? I don't know.
I see it as ideas for, if you're, it's kind of like it's kind of like what Mark Norman had asked, right? Like restricted from real estate investors, make it only for single family homes. That might slow down this like haves and have-nots thing.
Yeah.
You're making it so that you're only able to qualify for like only if you're at a certain income level, and it's only for entry level homes that might, kind of like stem the tide of like the haves and have-nots getting exaggerated.
Yeah, maybe,
all things to think through. Right?
Yeah, I mean, we're ultimately we've got a big affordability problem here, and to me, you can only focus on a few things if you want to make some major changes. You got maybe 1 or 2 or 3 things. You can't have like 10 things that are gonna actually be implemented. So if you start to kind of like pare it down and say, well, only these people and only in this, then you limit the potential impact of solving the problem. Yeah. It seems like a long shot to me, and not a clear win across the board because of some of the things that we've talked about.
Makes sense. Drew Barnhill in the chat is very much a fan of not meddling with real estate things. He's said a couple of things out there. Yeah. Mike Foster, as far as the summit goes, Mike's asking a couple of questions. I don't think we have these answers yet, but I just want to ask him out there in case we do.
Yeah.
Read through the 2026 Summit website this morning, and I have a quick follow-up questions. Will you be trying to reserve a discounted block of rooms at one of the recommended downtown hotels?
Good question. I don't know the answer on that one, but I can get back to you on that.
Is there guest parking available at the new JWB office?
Good question. Don't know the answer to that one. Get back to you. I love Mike. He helps me be so prepared.
That's a great question. Roughly what time each morning of the summit will each day's events likely begin?
Ding, ding, ding. Third question. That's a really good question. I don't have the answer to that one either. But I will write those down. We will get you answers for all of those things in the coming weeks.
We've got a save the date. We've got you can pre-buy tickets, right? Like at the end of the day, we have learned that like we've waited until having all these answers before to like roll it out. And in the meantime, the community is going crazy. Like, I want to buy my tickets. I want to reserve my travel. I want to do all this type of stuff. So we've been like, just kind of like releasing it so that people can actually make their travel plans. We promise you it's going to be a great time and you're going to be taken care of and you're going to have great connections and learn awesome things and connect with all your friends here. That's the promise that we can make right now. The details are to be defined.
Absolutely.
Right? Not your average guest here puts, hi guys, I'm new to real estate investing here. Not to sound unintelligent, impossible. You can't, there's no bad questions here, but when I hear you guys talk about it, it sounds like a different language. Any place to get started? Real estate for dummies.
Man, what an awesome comment.
It's a great comment.
Thank you for being here. Thank you for sharing that and having the courage to say that. That is awesome. We're so glad that you're here. Keep coming back. To answer your question directly, the best thing you can do is talk to folks that have been there before. So you can jump on the phone with my team. We are here to help people from the beginning, from day one. This is kind of like an advanced topic that we're talking about today. You jumped into a 301 level course here today, but in the show, a lot of our content is about the 101 level. So that'll be something to look forward to. But more than anything, talk to people who have done this before. I would encourage you to set up a phone call with my team and just let us know who you are, what you're thinking about doing, and then continue to come back here because there's a wealth of knowledge in the community here. You know, I'm sure you're going to get bombarded with people that are going to say, hey, I'm here to help. Many of them share their personal cell phones and, you know, would be super happy to help. So thank you for being here.
Yeah. If you're on the call right now in the chat and you say, I'm this person, somebody give me a call. I'm sure somebody in the community, right? Like nobody here is like in that chat, in the Zoom room, that's like sacred, right? Those are all folks that are all in our community, are also real estate investors, have done all this stuff. So feel free to make a friend in there as well. That's totally usable. Good stuff, GC.
Yeah, man, this was fun.
That was fun, man. That was fun. You know, I had heard the headlines. I wanted to get into it with you. We hadn't really had a chance to do it, but you did a good job. I love the illustration of the big takeaway for me was this idea of like, man, we're all so familiar with how like home prices go up over time, but few of us have really thought about how wages go up over time.
Right.
And even fewer of us have done the calculation of like what that wage looks like as a percentage of the mortgage payment over time. And I think that was a super, super powerful.
Awesome, man.
So
happy to help.
Hope to see everybody here next week. If you haven't bought your summit tickets yet, this is your last chance of us making the announcement. jwbrealestatecapital.com/summit. And you can go straight to that webpage. And the discount code is what, GC?
Summit 26.
Summit 26, because it's the summit happening in 2026.
What do you
That's
know?
how we came up with that.
That's how we came up with it.
Hope to see y'all next week. From now till then, any pieces of advice, GC?
Don't be average.